Good afternoon, everyone, and welcome to today's virtual non-deal roadshow. My name is Danielle Saul, virtual event moderator here at Renmark Financial Communications. And on behalf of our team, we want to thank you for joining us today for the presentation of Vista Gold Corp. Vista Gold is currently trading on the Toronto Stock Exchange as well as the New York Stock Exchange American under ticker symbol VGZ. Presenting today is Chief Executive Officer Fred Earnest. Now, without further ado, Fred, I'll hand over the floor to you.
Danielle, thank you. I'm going to start with a couple of introductory slides, some key messages that I want you to remember. First of all, the Mount Todd Gold Project is a world-class gold project. It's located in the Northern Territory of Australia, a Tier 1 mining jurisdiction. We have made a significant investment in the project to date with over $100 million invested. We consider the project to be de-risked and partner ready. The project itself has some very interesting characteristics with the economics, the size of the project, the operating costs, provides significant leverage to the rising gold price. We have made a significant investment in social relationships, government relations. We have a track record of being leaders with regards to environmental stewardship. And all of our environmental and operating authorizations and permits are now approved and in place. And that's a significant accomplishment. We have tremendous exploration upside, and we're going to talk about that. We have a strategy to develop the project in a way that increases shareholder value. That involves bringing in a partner, and we'll talk more about that process. You see in the center of this wheel on the left side, a little bit more about the project itself. With the reserves of 5.85 million ounces of proven and probable reserves, that number is going to grow in the coming months as we announce the results of a definitive feasibility study. And you see a little bit about the economics, the costs and production capacity over the first 5 years. We have a clear path to value realization. The near-term drivers in that plan involve the completion of a definitive feasibility study. As I indicated, we are making tremendous progress, and in the coming months, we expect to announce the results of that study. That study will include an increase in reserves. We believe there will be an improvement in project economics, and with the increase in reserves, there will be an extension of the mine life. We are in the process of seeking a strategic partner to partner with us to develop the Mount Todd project. We believe this will be a catalyst for recognizing intrinsic value and will provide an opportunity to minimize the equity dilution and debt burden that will be required of Vista to build this project. Now, Mount Todd is well advanced and de-risked. I'm not going to read through the list of each of these checked boxes, but what I hope you take away from this is, and you'll see a slide later in the presentation, developing mines and getting them to this point takes time. And we have now achieved a status where we have checks in nearly all of the boxes needed to commence construction. Obviously, our strategy involves completing the feasibility study, which I mentioned will be completed in the coming months, and reaching a point of announcing a transaction with a partner. Those are really the last major milestones that need to be completed. And so we're much farther advanced than nearly any of our peers in the developer space. With that as kind of an introduction of what we're going to talk about, let me talk about the company, our market structure, et cetera. As Danielle indicated, we trade on the NYSE American and the TSX under the symbol VGZ. 92% of our shares trade on the NYSE American. We have 117 million shares issued and outstanding. We've done, I think, an exceptional job of keeping our share count low and compact at the end of the second quarter, and we just announced results yesterday. But at the end of the third quarter, we have $16 million in cash. We have no debt. We have some very, very strong gold-focused institutional shareholders. You see there in the lower left-hand corner of the slide. And we have some very important analyst coverage that's provided, and I encourage you to reach out or look for and read the reports published by these analysts. Mount Todd, as it's presently designed, is positioned to be Australia's fourth largest gold mine. Obviously, we've mentioned that Australia is a tier 1 mining jurisdiction. It's a resource exporting country. It's mining friendly. They understand the industry and they're very supportive. In fact, there was a conference held the last 2 days in the Northern Territory of Australia called Mining the Territory. And Vista received prominent coverage and mention in that conference. I mentioned the leverage to rising gold price, and you're going to see a chart here in a few moments, but for every $100 increase in gold price, the NPV of the project increases $200 million. We're not aware of any other development stage project, advanced or of the scale of Vista, that enjoys that kind of leverage. The programs that we have going on between the definitive feasibility study and exploration drilling that's currently in progress are meant to demonstrate the upside of the project. They will not result in an increase in resources today, but they are demonstrating the upside that could be achieved with significant exploration expenditures, and we think this is very attractive to potential partners. I mentioned the de-risking. This is a process that's been ongoing for a number of years. We've improved gold recovery. We'll talk about that. We've achieved all of the major permits for the project. And now with the completion of the definitive feasibility study in the coming months, we think that this truly is a partner-ready project. On the environmental and social side, we've made significant strides. We've earned the trust of the community. I'll talk a little bit more about that. And then again, the development strategy. Please allow me to emphasize that this is designed to maximize value for shareholders, to minimize equity dilution and debt, and to unlock the value of the project without us incurring significant dilution. So diving into the project a little bit more, this is a large scale and easily accessible project. You see in the map, it's located in the very top end of Australia, as the Australians call it, the very northern part of the Northern Territory. It's located less than 3 hours from the capital and port city of Darwin, 10 kilometers east of the Stuart Highway, which connects Darwin on the north with Adelaide on the south coast. It's one of Australia's most accessible mining projects, and we've designed it as a community-based project, not as a fly-in, fly-out operation. With our proximity to Darwin, we enjoy access to key suppliers and skilled labor. You see on the right a summary, a chart that shows the size of the project in terms of resources and reserves, with 7.8 million ounces of measured and indicated resource, 5.85 million ounces of which are presently classified as reserves, and that number will increase. A greater percentage of the 7.8 million ounces will be converted to reserves through the work we're doing in the feasibility study, and I'll talk about why in a moment. As I mentioned, this is a large project. As it's designed with a 50,000 ton per day process plant, the mine will produce almost 500,000 ounces of gold per year on average over the first 5 years. This is very attractive to a senior producer or upper mid-tier producer as a partner. If we go to the next slide, you see a little bit more about the project. This is a brownfields project. It operated in the 1990s. We acquired it in 2006. Because of its past history, we enjoy some very significant investments that we don't have to replicate. For example, there are paved roads all the way to the site. There's a natural gas pipeline. And with that pipeline, we estimate we can generate power for about a quarter of what we could buy it for from the national grid. There's power lines to the site that's providing power and will provide power through the construction phase. You see the tailing storage facility and the freshwater storage reservoir. This is infrastructure that we don't have to make an investment in. And so with that, we've been able to achieve a capital cost structure that I'll talk about more in a moment that's in the lowest quartile on the basis of the capital cost per ounce of gold produced. And so there's some very distinct advantages. The deposit that we'll be mining underlies the Batman pit over on the left of the image. It extends for almost 1.6 kilometers north-south, and it extends at depth to almost 800 meters. This is a very large deposit, and we're very pleased to be the owners of it. I suppose no discussion today would be complete without some discussion of our environmental and social stewardship. We are and have been committed to environmental best practices since we acquired the project. We have a tremendous reputation in the territory with regards to environmental stewardship. When we acquired the project, the government had been managing it, and the pond that you see just over my shoulder captures acidic water from the waste rock dump. Government was allowing that water to be discharged straight into the local river, the Edith River. We stopped that practice. We began accumulating and storing water on site while we could find an appropriate treatment technology. Subsequently, we've treated over 11 million cubic meters of water, and we now have a permit to discharge clean water to the river rather than what the government was doing. This has earned us a tremendous amount of trust and respect in the local community. I talked about permits. All of the major permits for the project are approved. The EIS was approved in 2014. Subsequently, we were required to obtain a permit and authorization under the Federal Environmental Protection and Biodiversity Conservation Act. That was received in 2018. And in June of this year, we received the approval of our mine operating permit. In Australia, it's called the Mining Management Plan. Those are the three most important permits for the project, and all of them are approved and in good standing. Now, our social license, our environmental stewardship is an important part of earning that social license. But we work very hard with the local community, with the Jawa and Aboriginal people, with government leaders. We recently modernized our agreement with the Jawa people and replaced a 10% participating right with a sliding scale royalty. All of this has been very well received by the local community, the Jawa people themselves. I think it's important to note that over half of our employees are Aboriginal. We work very closely with the Indigenous communities, and they will be a very important part of the project as we go forward. We talk about de-risking, optimizing. We have, over the last 5 years, achieved some very significant accomplishments with regards to optimizing the Mount Todd project. On the gold recovery side, we have made changes to the process flow sheet that incorporating ore sorting and 2 stages of grinding that have allowed us to improve the gold recovery from 81.7% to now 91.9%. We have, in the same time, with the changes in equipment, our energy footprint has decreased by 10%. We're able to get rid of material from the flow sheet, from the process plant, before it gets to the grinding circuit. Material that's benign, that has no gold in it. We're not spending money to grind rock that has no value. We've got more efficient equipment today than we had 5 years ago. The result is that we require less energy. And so it's a greener operation than what it was 5 years ago. We think that combined with the gold recovery are very significant accomplishments. We've worked with industry recognized leaders. You see some of the names and the logos of the companies that we're working with at the bottom. If you were to Google any of these, you would realize that they're specialists in their respective areas, and we work very closely with them. Now, our last study was completed in 2019, and as I indicated, we're completing a new feasibility study that will be completed in the coming months. The results of the last study are summarized on this slide. Again, I note that this is a large project designed to process 50,000 tons per day of ore. You see the cash costs estimated to be $575 an ounce over the first 5 years and $645 an ounce life of mine. The all-in sustaining costs, including capital that will be required to be spent to sustain operations, bring the cost to $688 and $746. The capital costs are $826 million. This is a large number for us as a company. It's part of the driving reason why we're seeking to bring in a partner. But when we compare ourselves to other companies on a capital cost per ounce of gold produced basis, we're in the lowest quartile at roughly $157 an ounce. We're much lower than many of our peers who are looking at costs of over $200 and $250 an ounce to achieve the production in their operations. As I mentioned earlier, the existing infrastructure is a benefit to us, but part of it is just the design and the operation that we've proposed has been very thoughtfully considered with capital costs in mind. You see project economics at the bottom of the slide, what they were in 2019 when we had a much lower gold price and what they are roughly today. Today we have a gold price of over $1,800 an ounce. the exchange rate is 75 cents. But our after-tax NPV is about $1.6 billion today, with an after-tax IRR of just shy of 38%. I made reference to the leverage. The chart on the right simply graphically portrays this leverage and shows you what the NPV of the project would be at different gold prices. And the easiest way to summarize it is that for every $100 increase in gold price, there's a $200 million increase in the NPV of the project. This is leverage to the gold price at the project level. This is not financial engineering. It's simple accounting of costs versus revenue and what happens as the gold price changes. So there's tremendous opportunity here in that regard. Now, I mentioned the definitive feasibility study. A tremendous amount of the engineering for the Mt. Todd project is already at feasibility study standards, but not all of it. And that's demonstrated by the image that you see on the right. This is an image based on 3D AutoCAD drawings of the work that's already been completed for the design of the process plant at Mt. Todd. You see that concrete, structural foundation work, structural steel, buildings, tanks, mechanical components have all already been designed to feasibility study standards in 3D AutoCAD drawings and allow us to generate this image. Piping, electrical, and instrumentation designs are being completed at this time. And right now we estimate that they're over 80% complete. This will allow us to, in the coming months, announce a definitive feasibility study result, economics and costs. We've optimized the mine plan. We're using a higher gold price. This will result in an increase in reserves. The study that we just looked at the results from used a $1,000 gold price. Very, very appropriate gold price at a $1,350 spot price. But today with a spot price of $1,800, $1,000 is very conservative. And as we increase the gold price, there will be an increase in reserves. This will result in an extended mine life. We believe that being able to use a higher spot price for economics will result in improved project economics. We're completing some trade-off evaluations. We're looking at contract power generation, contract mining. These are both widely used in the mining industry in Australia. The trade-off is that they will result in a lower capex for the project, potentially as much as $180 to $200 million decrease. But the trade-off is that the operating costs will go up. As the operating costs go up, there will be changes in project economics. And those are the things that we're evaluating, whether it makes sense. We're also evaluating autonomous truck haulage. The single largest number of people that we have on site are truck drivers. And if we're able to use autonomous truck haulage, that will decrease the number of people that we need on site with only a modest increase in capital costs. So these are some of the things that we're looking at. We encourage you to stay tuned and watch for the results. Where we're at right now is that we expect to have the reports well advanced by the middle to end of December and be in a position to announce feasibility study results early in the new year. We talked about exploration. You see in the graphic on the right side of the screen that we have a tremendous land package. All of the resources and reserves that we report are located inside this small red box, which is the boundaries of the mining license. Surrounding that, we have over 1,500 square kilometers of exploration licenses that cover two structural corridors, the Batman Driffield Trend and to the north, the Cullen Australis Trend. We have, through grassroots exploration activities, identified a number of targets and areas where we've sampled gold in soils and in very shallow drilling. We believe there's tremendous opportunity to add resources with time across the mining license or the exploration licenses. But to date, most of our activity has been focused on the boundaries of the mining license. Here again, you see the boundary of the mining license represented by the red box. In the last year, we've undertaken an exploration program to advance our understanding of the mineralization in the district immediately adjacent to the Batman deposit. And here you see what I was talking about and what the potential size of the Batman pit is. We see what the current shape of the pit is, and the mineralization is such that the pit is going to grow. When it's finally developed, it will be 1.6 kilometers in length, north to south, and about a kilometer in width. The ore zone that we'll be mining will cover that entire strike length of 1.6 kilometers. It will vary between 200 and 300 meters in width through the heart of the deposit. And as I mentioned, it continues at depth for over 800 meters. 2 years ago, we thought that Gulf and Tullis and Quigley's were unrelated deposits and independent of Batman. Today, as a result of the drilling that we've completed over the last 12 months, we know that these are connected by structures and mineralized zones, and we're following up on that. We now believe that there's tremendous opportunity to increase the resources and ultimately reserves literally in the backyard of the Mount Todd deposit with the expense of additional drilling. Now, we're not going to spend that money. We think that appropriately done, it would take $10 to $15 million, but we believe that this would be an appropriate activity for a partner, or perhaps for the project itself to undertake once the project is in operation. The drilling that we're doing right now is demonstrating that there's tremendous opportunity to increase resources and ultimately add to the life of the project right in our backyard, inside the boundaries of the mining license, without having to step off and go to the north into the exploration licenses. Now, to kind of wind things up, and I know that question and answer part of these calls are sometimes the best part. We talk about being partner ready. And partner ready to us means that bringing in a partner means that we can immediately begin construction of the project. We are at a point where we're at the culmination of a strategic development process. This takes time. We've been very patient. We've worked diligently over more than a decade to achieve all of the permits that are required for the project, to complete the engineering, to undertake drilling that resulted in tripling the size of the resource at Mount Todd at the Batman deposit, to undertake a number of stages of metallurgical testing and process area design that has resulted in a project today that has the capacity to be the 4th largest project in Australia, to have very favorable operating costs, and to have a gold recovery of almost 92% that would be the envy of many, many projects. These things are all things that we think are attractive to potential partners. With potential production of almost 500,000 ounces per year, this is the size of project that is attractive to a potential partner of size and scale, one that has experience in developing and operating projects. This is the kind of partner that we're seeking to attract to the project. And we're at a point now where I think we can honestly say that we're at the culmination of a long process leading to finding a partner, and we're very excited about that. There's a tremendous opportunity here to make an investment in a project that has upside. When we look at where we stand compared to other developers, our project, the value of the projects that's reflected in our share price is significantly lower than our peers. That's an opportunity for you. We see it as an opportunity as a management team. We believe that completing a definitive feasibility study and ultimately getting to the point that we can announce a transaction where we have a partner will significantly change that valuation. And that's the opportunity that we see is represented for you as potential shareholders, or as shareholders who may have a small position or considering increasing your position, that there's a tremendous opportunity here for an increase in value. So how do we achieve that? Well, we have a development strategy that focuses on value creation. It's not a go it alone, dilute our shareholder strategy. It's a strategy that involves bringing in a partner that will help us recognize and achieve a valuation that's reflective of the characteristics of the project, its size, location, stage of development. We aim to preserve maximum project ownership for our shareholders, and that may vary depending on the size of company that we're able to partner with. We hope to minimize the dilution that will be incurred. And we're seeking a partner who will pursue the development of the project on an aggressive basis. We believe that first gold can be achieved within 3 years from the point of completing a transaction. Now we have an outstanding asset to do this with. It's located in a tremendous, in a tier 1 jurisdiction. It has size, and the size is going to increase. The costs are very favorable. All of the environmental permits, the things that take time and cause delays, are already in place. The social license is in place. We enjoy tremendous support for the project in the project area. And there's potential to increase the size of the project to extend its life. The execution of the strategy is key. The milestones are completing the definitive feasibility study. And as I indicated, we expect and are on track to announce results early next year. We're engaging with partners. There's a lot of work that's being done in our virtual data room. And we expect that there will be additional companies that sign confidentiality agreements in the coming months as we continue to announce results and move toward this process, the culmination of finding a partner. We're building on our environmental and social achievements and maintaining that social license. And we're committed to narrowing the gap between our market cap and the project NPV. That's the message I want to leave you with, that we have a strategy. We have the asset to achieve the strategy, and we are focused on execution of that strategy. And with that, I will conclude and we'll open it up for questions and answers.
Thank you very much, Fred, for this great presentation. You are right. We'll now move on to the question and answer portion. I will begin with your first question. How leveraged are you to the gold price?
We're unaware of any other development stage projects that enjoy the kind of leverage that we enjoy, i.e. our NPV, the NPV of the project increases by $200 million for every $100 change in the gold price. Now, there are some very large operating mines that enjoy that kind of leverage, but we're not aware of anybody in the developer space, such as where we are, that's advancing projects that has that kind of leverage. And this is the result of simple economics. It's revenue versus costs. As the gold price changes, our costs stay pretty constant. As the gold price increases, our revenues increase tremendously as a result of having an estimated recovery of almost 92%.
What does management think the market is missing with this story?
This is a brownfield site. This is a project that operated in the 1990s, first as a heap leach operation, subsequent as a very small milling operation. And ultimately, the owner of the project at that point in time went bankrupt. It happened in 1997. It was a period of time where the gold price was languishing around $320, $315 an ounce. And simply they couldn't make a go of it at that price. There were a number of people that lost money on those early operations. I believe that that's one of the things that affects our share price. The other is simply the large size of the project today. The $826 million capex is another factor that I think people have a little bit of a hard time with. Now, as I mentioned, we recognize that that's a large capex, but we've designed this as a large project. This is not a project that's going to produce 100,000 ounces of gold per year and has a capex of $200 million. That's not the way this is designed. We have designed this project as a project that's attractive to a senior producer, an upper mid-tier producer, someone who wants a project that's going to produce a lot of gold and make a lot of money. But that requires a significant investment. But as I pointed out, on the basis of investment per ounce of gold produced, we're in the lowest quartile of developers advancing projects right now. I think that the fears of dilution are one of the things that investors struggle with. And it comes down to this message that we've been conveying to the market for a long time now, that we are not going to develop this ourselves. We're going to find a partner. We will bring in a partner to develop the project. We've been affected by COVID. We're not able to travel to Australia. Potential partners are not able to travel to Australia to complete due diligence. And as a result, the process of finding a partner has been slowed down. We see light at the end of the tunnel. The government in Australia has recently announced plans to allow fully vaccinated citizens and their families, their relatives, to return to Australia, to travel to and from Australia. We believe that there will be an extension of this, that foreign business people and tourists even will be allowed to begin to travel to Australia in the new year. And we're very excited about that. We believe that this will create opportunities for on-site due diligence and will significantly accelerate our process of finding a partner.
The AISC is certainly a low number. Do you feel that the DFS may indicate a lower cost?
The all-in sustaining, our cash costs are estimated to be $575 an ounce over the first 5 years, with an all-in sustaining cost of $688. That cost is likely to go up slightly as we complete the definitive feasibility study. The capital cost will also go up a little bit, but we believe that on a cost per ounce basis, the initial capital cost is going to go down. Now, there's a couple of things that could change that. Our capital cost could go down if we elect to have a contractor own and operate the power plant, or operate that, to have a contract miner that does the mining. That will reduce our capital costs. The all-in sustaining costs are a very important part of the project, and being in the Northern Territory and being located where we're at, one of the things that allows us to achieve a lower cost structure than many of our peers in Australia is this fact that the traditional mine in Australia operates on a fly-in, fly-out basis. They have a camp. They fly people in and out every 2 weeks. They have 4 crews of people in order to sustain 2 crews working 12 hours a day. As a community-based project, we will have a project where our people will live in Catherine or Pine Creek, very close to the project, within 30 minutes. Very much a Western US style model for the development and operation of the mine. And as such, we'll have 3 crews of people instead of 4. That will allow us to be more efficient. We'll not have the expenses of having a camp. We'll also not have the expense of flying people in and out. Those are some of the things that contribute to our lower cash costs and all-in sustaining costs. One of the other things is that we've designed the project with large equipment, and mining fleets are lasting longer today than they have in the past. And so our all-in sustaining costs, you see the sustaining capital is approximately a third of our initial capital investment. Most of that is in mining equipment replacement. We've worked very, very hard. We've been very thoughtful in the design of the project and have tried to take advantage of all of the opportunities available to us to be efficient in the design of the project through large equipment and minimizing the labor force, both through the use of large equipment and through having a community-based project, all of which contribute to our very efficient operations of the project.
What is the expected construction time to get to commercial production?
Our engineers believe that this project can be built in 18 months. We enjoy, as a result of the existing infrastructure, the fact that most of the civil works in the plant area have already been completed. They're quite confident that it can be built in 18 months. We're a bit more conservative. In our planning and in our economic evaluation, we have allowed a construction period of 24 months. We know that delays in construction happen in our industry, and while our engineers are confident they can be moved forward more quickly, we plan for a 24-month construction period. Additionally, we have contemplated a 6-month ramp-up period and commissioning and ramp-up in addition to the 24 months. So while our engineers would say that we could probably achieve commercial production in something on the order of 20 to 22 months, we've estimated that it will take 30 months. I think that sets the stage for us to outperform and over-deliver rather than being on the opposite side of that coin.
How much does the existing infrastructure save you in costs?
It moves around a little bit year by year, but the last time we looked at this was a couple of years ago, and we estimated that the savings in capital as a result of the existing infrastructure was about $135 million. Or in other words, if this were a brownfields project and we had to build things from scratch, our capital costs would be about $135 million more than what they're estimated to be.
Do you see Sun Valley increasing their position once the definitive feasibility study is complete?
Sun Valley has been a long-term supportive shareholder. They have participated in all of our financings since, I believe, since 2008. We have regular communication with them. We listen to what they say. They're a very, very active shareholder. Whether they will increase their position or not is to be seen. They've not indicated to us that they will or they won't. They have in the past bought in the market, in addition to taking significant investments in fundraisings and financings, in 2010, 12, 16, and 21. In the period of time 2017, 2018, we are aware, we do know that they were active buying in the market. That's a possibility. Sun Valley tends to be a bit more proactive. If they were to buy in the market, I would expect they would buy in the market leading up to the announcement of the feasibility study results, and not wait until afterwards.
Is the definitive feasibility study due in Q1 or Q2 of 2022?
No, definitely Q1. As I mentioned in the presentation, with the engineering and design work over 80% complete, we are on track to have the draft reports for our review in December. And we are targeting that we will announce results in the first part of the first quarter of next year.
How many other projects are within the area?
The Northern Territory is a big place, and there's a lot of mineral activity. There are manganese operations, uranium operations. The closest gold projects, Kirkland Lake, now, soon to be Agnico Eagle, has a project about 50 kilometers, 40 to 50 kilometers north of us, called the Union Reefs, where there's a mill that has operated in the past. The other significant gold operations would be to the south of us, 400 or 500 kilometers, I would guess, maybe a bit more. That would be the Newmont's Tanami operation. That's a project that has just about the same production capacity as Mount Todd. Those would be the two largest local gold producers. But there's the Northern Territory is a very large place. And there are a number of mining operations, both within several hours of us, that are metals or commodities other than gold. But the largest, the more significant gold operations would be those owned by Agnico Eagle and Newmont.
Does the project have any byproduct metals?
We will produce a small amount of silver. The silver grades are less than a gram per ton. The recoveries are substantially lower than the gold recoveries are, and that's by design. There will be some byproduct credit for silver. There is some gold. In addition to the silver, there is some copper, lead, and zinc that's associated with the deposit. The grades, however, are so low that we have made no efforts in our process design to try and recover them. And so there will be no byproduct credits from those metals.
How can inflationary pressures affect your upcoming DFS?
Well, that's something that we all watch very closely. Interestingly, major equipment components, both on the mining side and the process side, we're starting to see the initial quotes. We are not observing any significant changes in the cost of equipment. Freight charges are going up. That will affect things. Steel and concrete prices are up, and in some cases 30%. But steel and concrete as a total part of the project are less than 5%. So they're not a significant impact on the project. Labor costs are another area where there's potential for inflationary pressures. We have been very conservative in our estimation of labor costs in past studies. And in fact, this was borne out by a benchmarking study that we completed in 2019, where it was noted that our labor costs were likely significantly higher than what would be incurred. Today, as we look to the completion of the definitive feasibility study, we're expecting only a 2 to 3% increase in labor costs. And so as we look across the spectrum of the inflationary pressures right now, we're expecting that they will be very minimal, in part due to there just hadn't been some changes on major equipment items. But those areas where we have seen significant changes in prices, like I mentioned, concrete and steel, they're very minor parts of the project. On the operating cost side, in Australian dollar terms, there are energy costs, both natural gas and diesel fuel costs are almost exactly the same as they were 3 years ago. Now, the difference is that we have a different foreign exchange rate. 3 years ago, we used a 70-cent foreign exchange rate. Today, we're in the range of 75 to 76 cents. And it's projected long-term that will be the range where the foreign exchange rate stays. For changes in foreign exchange rate, that 5 percentage point difference will have a greater impact on project economics than any other specific inflationary change in the project. We expect to see some changes in reagent costs, but again, those are a very small part of the cost of the project. So, we're actually very pleased that where things are at and the way we've handled past studies with being appropriately conservative as we now advance to a definitive feasibility study. Early indications are that the inflationary impacts that may be experienced by other operations are going to be substantially less at Mount Todd, comparing ourselves to past studies.
What percentage of the project would you be comfortable giving up?
Well, our goal, our stated goal is to retain as close to 50% of the project as possible. Now, the reality of that is that depending on the partner, depending on their strength, their what they bring to the table, it's unlikely that we'll be able to retain 50% interest in the project. It really depends on economics. Our goal is to retain as much as we can and to achieve value for the portion that we give up that will allow us to cover the majority of, if not all of, the equity contribution that we would be required to make as a partner. That means that, realistically, we'll probably find ourselves in a 60-40 type of arrangement or 65-35, maybe even a 70-30, depending on the economics, depending on the price that's negotiated for the partner to come into the project. And again, our objective is to retain as high a percentage as we can, but of course, ultimately, it will depend on the economics of the transaction.
Have you looked at building a smaller mill initially to help pay for an expansion?
We have. Over the last 5 years, we have completed significant design work on projects with plants that range from 15,000 tons per day to 65,000 tons per day, almost at 5,000 ton per day increments. Up until 2019, carried an alternate case in our technical studies that showed a slightly smaller and higher grade 33,000 ton per day case. Ultimately, the economics of the project are most favorable when we're able to take advantage of economies of scale with larger projects. Additionally, our strategy is to bring in a partner, and partners are looking for larger production, lower costs. Obviously, that's achieved with a larger initial capital investment. If we were to find ourselves in a position where we absolutely could not attract a partner and we were forced to build the project on a standalone basis, we have the preliminary engineering completed at a number of different sizes of smaller projects that we could evaluate. But ultimately, we believe that the fastest and the least risky way to create value for shareholders is bringing in a partner and pursuing a larger scale project, and that's the reason that we've advanced the project as we have.
What is the plan with the cash on hand?
The cash on hand, as we raised money last July, we indicated that the use of proceeds would be to complete the feasibility study and to complete the drilling program that's currently in progress. And And those were two important uses of proceeds. That was approximately $5 million of the 12.3 that was raised. The remainder of the cash will be used to sustain our efforts as we advance in the process of finding a partner. Our burn rate, our operating day-to-day operating costs, fixed costs as we call them, are evenly distributed between Mount Todd and the corporate office at about $3 million a year each. And with that, we maintain the site, comply with all of our environmental obligations, and are able to undertake the work that we do here based out of Denver with regards to advancing the project.
Any new recent additions or changes to your institutional shareholders?
With the financing in July, we added a number of new shareholders. Our existing major shareholders participated in the financing. We know that Sun Valley, Lowe's Corp, and members of the Vista board and management all participated in the financing. Additionally, the lead offer on the financing was another institutional investor who prefers at this time to remain unnamed, but they took a position in the financing that places them as our second largest shareholder with a holding of 4.9% of our issued and outstanding shares. There were a number of other new names that came into the story with investments in the range of 0.8 to 1% holding in the company. So we're also aware that there have been private wealth managers, family offices that have taken significant positions in the last 12 months, adding on the order of 500 to a million shares to their 500,000 to a million shares to their accounts. So there is interest. There is an increase in the number of larger shareholders, and we're very pleased with that. And we're grateful for their interest and their support.
Thank you very much, Fred, for taking the time to answer these questions. Ladies and gentlemen, this now concludes our question and answer session. Now, Fred, I'll hand over the floor to you one more time for final remarks.
Very well. Thank you, Danielle. And thank you to all of you who have taken time to join us for this hour. I believe that the questions have been exceptional, very informative, and I hope that the answers have helped each of you in understanding the Mount Todd project and why we believe that this is one of the truly exceptional investment opportunities today. I would just leave you with the thought that this is a world-class project, that we have a development strategy that is focused on creating value, and that there are catalysts that are currently in progress that will lead to the creation of value. We have the right asset, and you'll be able to measure our progress as you watch for and see the results of the definitive feasibility study. We will not be announcing preliminary results for that study. The exchanges don't allow us to do it, but we are on schedule for an announcement in the early part of 2022. We believe that this will be a tremendous stepping stone to reaching the point of serious discussions and negotiations with potential partners. And we're hopeful that in the new year that we're able to ultimately announce that we've reached an agreement with a potential partner. These two things we believe will be very significant catalysts in driving value for the Vista shareholder. We invite you to look at this seriously and don't miss this opportunity. And with that, we wish you all a very pleasant day.
Thank you very much, Fred. Now, once again, this was Vista Gold Corp, currently trading on the NYSE American under ticker symbol VGZ, and as well as on the Toronto Stock Exchange under the same ticker symbol VGZ. On behalf of Renmark, I want to thank everyone in New York and surrounding areas for joining us for today's presentation. We do hope that you stay tuned for future presentations in your area. And until we meet next time, stay safe and be well. Bye-bye.